the trade deficits really started to explode, I think, in the 1980s. But a lot of it was the result of going off the gold standard in the 1970s and getting to a position where we no longer had to produce stuff. We could just print money. Because when we were on the gold standard, we couldn't just print money because we had to mine gold first. But once we went off the gold standard and we could just create money out of thin air and then use that money to buy what everybody else produces, we started printing more and producing less and relying more and more heavily on the rest of the world. And that was also an escape valve for American corporations, because as we increased regulation and taxation, the way U.S. businesses were able to survive was to move all of their production offshore and to take advantage of what was then much cheaper labor in a regulatory environment that was a lot less costly. And so we were able to survive because of all that outsourcing. But now, of course, all those decisions are coming back to bite us because we've destroyed the productive capacity of the country. And now we're very vulnerable. You can look at what's going on with these global supply chains, and part of the problem is that whatever we want to buy first has to be shipped over here from China. And not only does it have to be shipped over from China and then unloaded on a port, let's say in California, but now everything has to be individually loaded up on trucks and sent to various parts of the country. Back when we produced our own stuff, we had factories all over the country. So stuff didn't have to come here on boats, and then a lot of the stuff that was produced was very close to the end consumer. But now if everything is showing up in Long Beach or Los Angeles and you got to ship it all over the country, I mean, it's very expensive to distribute all the stuff that we import. We were printing money to war on poverty, and we were printing money to have a war against Vietnam. Ironically, we lost both wars. We lost the Vietnam War, and we lost the war on poverty because poverty won. We ended up with a lot more poverty after the war than we had when the war began. Of course, everything the government does backfires, which is why I said that about the sanctions. But yeah, I mean, people forget that the inflation of the 1970s was rooted in the monetary policy and the big deficits of the 1960s.
Yep.
And so the inflation that we're going to experience in this decade that has just started is going to be far worse than anything that we experienced during the 1970s, because the monetary and fiscal mistakes that were made this time are much bigger than the ones that were made last time. And in fact, if you look at year-over-year CPI, which the government claims to be about 8%, if we were measuring the CPI today using the same CPI index that we were using during the 1970s, the CPI would be at least double what the government is reporting. So it's not 8%, it's 16%. And so by that measure, we are already experiencing inflation that is worse than any year of the 1970s or the early 1980s. And this is 2022. This decade is just getting started. Imagine how much higher inflation is going to be when we're nearing the end of the decade. Interest rates are going substantially higher from here. I mean, they're still much too low. We're now kind of approaching 3% yields on U.S. Treasuries. We're not quite there yet. The yield on a 2-year U.S. Treasury is about 2.75, and if you go out 30 years, you're about 2.6. So we're still below 3. But if you figure that inflation is 8, and that's what the government admits, as I said, it's at least double that. But if you just accept the government's version of inflation at 8%, why would you loan money to the U.S. government for 30 years at 3%? I mean, you're losing 5% per year to inflation. Your principal is being eroded in value, and you're not being compensated for that at all on the coupon. Interest rates need to be much higher than the rate of inflation. In 1980, Volcker had short-term rates up to 20%. The highest inflation got in 1980 was 13.5%. So you had a huge gap there between the interest rate and the inflation rate, so there were very strong positive real interest rates. We still have historically low negative interest rates. The Fed is continuing to fuel the inflation fire by holding interest rates artificially low. Even though they're raising them slowly, and even if they raise them in 50 basis points clips, that's still too slow. I think that if the Fed follows through with its threat to shrink its balance sheet, and that really is a threat, because if the Fed shrinks its balance sheet, bond prices are going to implode, because that means the Federal Reserve is now competing with the U.S. Treasury. The Treasury has to unload $2.5 trillion worth of bonds this year. If the Federal Reserve is going to unload another trillion or $1.5 trillion, you got $4 trillion worth of low-yielding treasuries looking for buyers. And by the way, the Social Security so-called trust funds, they're now selling treasuries too because they're running at deficit. So the government is trying to unload trillions and trillions of low-yielding bonds in a high inflationary environment. Bond prices have to collapse, interest rates have to skyrocket, and that's going to wreak havoc in the stock market, in the real estate market, the entire U.S. economy, because thanks to the Fed, everybody is loaded up with debt. The government is loaded up with debt on all levels, federal, state, local, corporations, households. Everybody has been gorging on debt thanks to artificially low interest rates, which made that debt appear manageable based on how low the servicing costs were. Well, all of a sudden, the interest costs skyrocket on all this adjustable rate or short-term debt, and now debt that was manageable is completely unaffordable, and that means the debtors default, and we know what happens then. We saw that movie, in 2008, only the sequel is going to be even worse, which is generally the case, right, with sequels, and you're going to see a bigger wave of defaults and bankruptcies and foreclosures in this financial crisis, which again will be much worse than the last one because it's also going to be a currency crisis. We're going to have massive inflation at the same time we have the financial crisis. There's negative interest rates everywhere. I think they're the most negative here because we've actually got the highest inflation. So even though we have higher nominal rates than what you would find in Europe or Japan, we have lower real rates. And of course, that's the unofficial. The real inflation rate, or the official one, the real one is quite a bit higher than that. But look, when mortgage rates go up, and now they're back up to about 5%, and historically that's still low, but in recent years they've been well below 4. I mean, people were getting mortgages below 3.5% on 30-year fixed. And if you look at home prices, because they're up like 20% year over year, home prices are at record highs. And home affordability is at a record low, and that's before interest rates go up. So the only thing that's keeping these overpriced homes marginally affordable is the low mortgage rates. But if you take away those low mortgage rates, and mortgage rates move back up to maybe 7, 8, 9%, which was normal, before the '08 financial crisis, we get mortgage rates back there, something's got to give.
Oh, yeah.
Otherwise, nobody can afford to buy a house. And what's going to give are the home prices. Home prices are going to crash. But what's not going to happen, though, is new construction, because inflation is driving the cost of building new homes through the roof. So we're not going to get any new homes. If you want a home, you're going to have to buy one of the homes that already exists. But if you don't have any money, and somebody wants to sell you a house, I mean, the price is going to have to go down. At some point, real estate could become an all-cash market because most people may not even be able to qualify for a mortgage.